Good evening, everyone. My name is Kim Flynn, and I'm a financial advisor at Thrivepoint Financial. Thank you so much for attending Financial Planning for Young Professionals. The reason why I created this webinar is because I feel like when you graduate college, there's a lot of unknowns, and most people can use some guidance to start off on the right track. I'm hoping by the end of this webinar, you feel like you will have some tools and education to apply this to your everyday life. So starting off with financial advice from social media. There is a lot of information on social media, and the financial advice is no exception. Oftentimes, people who are showing these videos may not be qualified to provide financial advice, and it could be misleading or a blanket recommendation, meaning that it's not suitable for everyone, and they're just saying this to the general public. Financial recommendations should be suitable for the individuals. So by providing financial advice on the internet, it's not always the best information out there. So let's watch this first video together.
It all starts with baby step one, having this foundation, saving $1,000 for a starter emergency fund. This is just a small buffer between you and life before we start tackling the debt.
Exactly. And if you have $1,000 already, great. Just set that aside. That's your baby step one. Any money you have that's not retirement, anything you can sell that is not retirement, you're going to liquidate it.
So this video talks about having a starter emergency fund. An emergency fund is very helpful. It should be 3 to 6 months of your expenses to provide a nice buffer. So if you had a job loss or a emergency where you needed cash, you could have this money and have access to it. This clip is saying that a starter emergency fund should just be $1,000 and then you pay off all of your debt. However, if you have a large amount of debt that will take a long time to pay off, you potentially become in more debt if you had an emergency and you only had that $1,000 of liquid money to access. Next video we'll watch here is talking about Roth IRAs.
Roth IRA, my financial tip of the day, open it as soon as possible, put 50 bucks, 100 bucks, max it out. If you're over 50, you can contribute up to $7,500 a year. It's after tax, but it's not taxed once you get to retirement. It is perhaps the number one thing we can do, ladies and gentlemen, but I focus on women. Not by far number one thing you can do, and you need to get the clock started because there's a 5-year period where you can't touch the money.
So in this video, she is saying that a Roth IRA is the number one thing you should do. However, she doesn't know any of the financial circumstances her audience is in. It's not right of her to provide this blanket recommendation. And actually, Roth IRAs, they have an income limit. So they could be suitable for some people, but other people may not be allowed to contribute to a Roth IRA because their income is too high, and they could potentially incur a penalty by the IRS if it's not corrected. And the last video we'll watch here is about real estate investing. So in this video, it's kind of glorifying investing in real estate. It might be suitable for some people, but for other people, it can become very complex on a taxation basis, management, and feasibility. And this gentleman is unfortunately making it seem like it's a pretty straightforward process and most people would become millionaires when that might not necessarily be the case. By showing these videos, I hope that it will show you that you shouldn't trust everything you see online and that it's important to consult with a professional. So we'll hop into section 1. This section is about budgeting by percentages. Budgeting can be very tricky. It can cause some financial stress, and most of budgeting is done on an Excel spreadsheet where you are only allowing yourself to spend a certain amount of money in each type of category. Well, life can get complicated very quickly, and you may need to get out of that box. I like to talk about 3-layer budgeting, and it allows for a more flexible way to budget. It's more of a framework than something that's strict. Starts off with ordinary living expenses, debt payments, and savings. So savings. Start by trying to allocate 10% of each paycheck towards some method of savings. This should be in a bank account that's easy to access, such as a traditional savings account or a high yield savings account, and it should be focused on liquidity rather than growth. And before you take advantage of employer-sponsored plans and individual investments, it's important to have this savings built up to 3 to 6 months of your expenses. Debt repayments. So this would be any type of financing that is more than 1 year in duration. Examples include a car loan or student loans. And try to keep debt repayments within 20% of your monthly income. So if you're in the market for a new car and you need a car loan, then when you're shopping around, aim to have your car loan be about 20% of your monthly income or lower. Ordinary living expenses. So this is the biggest part of the puzzle. It's 70% of your budget. So this would include housing expenses such as mortgage or rent, credit card payments, utilities, and fund money. Life can get very expensive, and this is why it's the largest part of the pyramid. It's meant to be a flexible part of budgeting, and budgeting shouldn't be so strict because it can actually cause you to overspend. It can be similar to a restrictive diet where you are only allowing yourself to eat a certain portion of food, and then by the end you may say, oh, well, I already just ate more than I told myself I would eat, and then ruin the diet. This is similar to budgeting. If you spend more, then you could potentially say, oh, well, might as well just continue spending frivolously. Next part, section 2, credit. So what is credit? Credit is when the lender allows the borrower to use their money in return for an interest rate and any fees. The borrower has a promise to repay the loan later, and a person's creditworthiness determines the amount of money they are allowed to borrow. So for example, if you apply for a credit card, you'll be allotted a credit line, and then as you are making more payments, they're on time, maybe you're paying off the bill in full, that will determine your creditworthiness, and the credit card company could offer you a larger credit line. How to build credit over time. Start to use a credit card for small purchases and then pay the bill off in full. For example, when I started to build my credit, I took out a credit card for gas. So I would put all my gas on that one credit card and then pay it off in full. This was helpful because I wasn't tempting myself to spend irresponsibly with credit with my first credit card, but I was starting to build the credit so I could become more credit worthy. Don't apply for multiple credit cards within a short time frame. This will put a hard inquiry on your credit. Then credit card companies and lenders, they may think that you are not as credit worthy. Pay your bill on time every time. This is crucial. Your payment history, it's a large factor of your credit score. So you want to make sure that you pay your bill on time every time. Set up auto pay if you need to set an alarm or a reminder in your calendar or phone, or write a sticky note on your mirror. Do that so your bills are paid. And use less than 30% of your credit limit. You don't want to use your entire credit line because that will show that to lenders that you are potentially overstretching yourself. Some risks of low credit: it could be challenging to rent or buy a home, and lenders will be more likely to deny your application. Or if they're willing to accept your application, the loan or credit card interest rates can be much higher the lower credit score you have. There are different reward credit cards. These will give you some type of cash back or points. If you put all of your fixed expenses on this credit card each month, you can build up your points, which will be free money. And this cash back is a rebate, so you won't have to pay income taxes on it. Section 3, investments. In the world of investing, there's a lot of different terminology. You may be familiar with some of these terms, so it may be a refresher, or it could be terms that you've heard before and you're unsure of what they are. Starting off with, what is a stock? A stock represents ownership of a company. Stocks are designed for growth in a portfolio, and too much stock in an account can become dangerous. Reason being is that if a company were to go bankrupt, their stock price could go down and it could potentially expire worthless. What is a bond? A bond represents debt of a company, municipality, or federal government. This is common if a municipality or the government wants to do some type of project. They may issue a bond so they're able to finance the project that they're working on. Bonds are typically considered lower risk, and the closer you are to retirement, the more suitable bonds become because of their lower risk than stocks. What is a mutual fund? These can be comprised of all stocks, all bonds, or a combination. They have an active human manager buying and selling on your behalf. If you have an investment account already, it's likely that you're already invested in one or more mutual funds. Looking at investment allocation, this is the process of deciding where you want your money to work in the market. An example would be 90% equity, 10% fixed income. This would be suitable for someone who is maybe new out of college. They have a long time until retirement, so they're able to take on more risk compared to someone who is maybe in their mid-career and closer to retirement. So your investment allocation will change throughout your working career, and it's important to review your investments so you are not investing too aggressively or too conservative for your age. When to start investing? Ideally, as soon as possible. The reason being is the longer your money is invested, the longer it earns compound interest. I like to think of it like a snowball. When you're building a snowball, the snow builds upon itself and creates the snowball. When you invest, your money will earn interest, and then that money that earned interest will earn interest, and it just keeps on compounding. So the longer it is, the more time it can have that compounding effect. Take advantage of employer matching contributions. It's essentially free money and part of your compensation package that your employer is offering. Your return and investment account is made up of consistent contributions, market timing, and asset allocation. Consistent contributions will typically have the most impact on your return. The next up is employer-sponsored retirement accounts. There are a lot of different accounts out there, and it's important to understand what you are investing in. You don't necessarily have to know the ins and outs of each account, but I'll go over some of the basics. So 401k, this is a very popular type of retirement account. This allows you to contribute to retirement on a pre-tax basis. When you retire and withdraw the money, you would pay the taxes then. There are Roth accounts where you contribute on an after-tax basis. It would be tax-free in retirement. There are simple IRAs. These are employer-sponsored IRAs for a small business. There's also SEP plans. They're designed for self-employed small business owners. There's profit sharing plans and employee stock ownership plans. Some companies offer these so you can be a part of the profits or stock in the company. There are non-retirement accounts. The money is taxed before the account is funded. So you get your paycheck, the money is deposited into your bank account, and then you would contribute to a non-retirement account. You're able to withdraw your money prior to retirement without any penalties. This may be helpful for when you're saving for a large purchase, such as a home. Next up is Roth IRAs. So we touched briefly on how Roth IRAs may not be suitable for everyone, and I'll go over some of the highlights of how they work. So earnings are tax deferred. They're funded with after-tax dollars. Earnings are subject to a 10% penalty if they're withdrawn prior to age 59.5 and you haven't held the account for more than 5 years, but your contributions can be withdrawn at any time. You're able to withdraw earnings up to a maximum of $10,000 for a first-time house purchase. So with Roth IRAs, they also have income limits, so they're not suitable for everyone. For example, if you are a single person in 2023, once you hit $138,000 in income, the amount you can contribute to a Roth goes down. Once you hit $153,000 in income, you're no longer eligible to contribute to a Roth IRA. Section 4, insurance. Life insurance. This is important because it will provide your loved ones with a lump sum payout when you pass away. This will allow your family to focus on grieving rather than their finances. And by purchasing a policy when you're young, the premium will typically be less because you're never younger and healthier than you are today. I have a family member who was diagnosed with melanoma. She's doing okay now, but unfortunately, because of this, she may not be able to get life insurance. Things like this can happen when you don't expect. You can have some type of health event that can change your insurability, either make you uninsurable or make it more expensive. So locking it in now when you're young will have a big impact. There's different types of life insurance. There's whole life, universal life, and term life. Whole life and universal life, they have a cash value component, and term life has no cash value and it will expire at the end of the term. So what is life insurance cash value? This is a separate part of a life insurance policy, and it will have some growth over the time you have the policy. This money can be withdrawn or loaned out. And depending on the policy type, the cash value increase may be guaranteed. Disability insurance. Did you know that a 25-year-old has a 58% chance of becoming disabled for 3 months or longer before age 65? It's common to think that you may not need disability insurance if you work at a desk, you don't have a risky job, but it's actually that 90% of disabilities are caused by illnesses, not accidents. So whether you do have a risky job or you don't have a risky job, it's important to have disability insurance protection to protect your ability to have an income. Typically, employers will offer disability insurance, but it may not be enough to provide adequate income. Reason being is that if your employer pays for disability insurance, the benefits will be taxed. Personal disability insurance can also be known as supplemental disability insurance. Coverage can last a set number of years or until a designated age, and benefits will be received on a tax-free basis. Additionally, the coverage can go with you no matter what company you work for, and it can grow as your income grows. Employer benefits. So when you're looking for a new job, it can be very overwhelming to understand your benefits. So some benefits to consider: bonus compensation, retirement plans, stock option plans, disability, life, and health insurance, paid time off, and tuition reimbursement or student loan forgiveness. These are important factors to consider when looking for a job or evaluating your benefits package. It's important to understand that this is part of your total compensation. So if a company is offering you a salary that you don't necessarily agree with, consider these different employer benefits to see if maybe it's worth accepting the lower salary. Do your research on the industry and learn about a typical pay structure. If you think that your pay or benefits are not enough, then negotiate it. But don't negotiate just to negotiate. Do your research and be well informed so you can have some substance when you do your negotiation. When you're looking for a new job, there's a lot of different questions you can ask, but here are some highlights. What is the company culture like? Do you think you'll become best friends with your coworkers, or would you feel better in a larger company where you don't see the same person twice in one day? Are there opportunities for growth professionally and financially at this company? What type of skills and experiences are you looking for in an ideal candidate? What are the current goals this company is focused on, and how does this team work to support hitting those goals? These are some questions you can ask, and there's plenty more, but it's important to be prepared for an interview. So I find that when people are looking for medical advice, they go to a doctor. When they're looking for legal advice, they go to an attorney. When people are looking for financial advice, they go to a financial advisor. If you feel like it would be helpful to have an outside opinion who's helping you make financial decisions, then working with a financial advisor could be of benefit to you. There are different ways that we work, and if you fill out the post survey with your contact information, I'll reach out to you to schedule a consultation.